Before you sign that car loan, let me show you how to avoid the EMI trap that's keeping millions of Indians financially stuck. I'm Aswad, and today I'll walk you through a smarter way to buy your dream car without drowning in debt. Step 1. Calculate your true affordability. Here's the rule. Most people ignore your total EMI should never exceed 40% of your monthly income. If you earn 0 rupees, your car EMI shouldn't cross 0 period. Step 2. Consider the 50-30-20 approach. Save 50% of the car's value as down payment, finance 30% through a loan, and keep 20% as an emergency buffer for insurance, maintenance, and registration. Step 3. Explore alternatives to traditional bank loans. Credit unions, employee financing schemes, or even borrowing against your mutual funds often offer better rates than standard car loans. Step 4. Think total cost of ownership. That 10 lakh car will actually cost you 15 lakhs over 5 years when you factor in interest, insurance, and maintenance. The smartest buyers often choose a slightly older model or wait 6 more months to increase their down payment. What's your biggest concern about car financing? Drop it in the comments below.